Okay, let's unpack this. We're diving into the pretty dramatic global financial fallout from these escalating US-Iran tensions back in June 2025.
Right. It all really kicked off with those U.S. airstrikes.
Exactly, hitting key Iranian nuclear facilities, Fordo, Natanz, Isfahan. That was June 21st. And that really ramped up the whole Israel-Iran conflict picture.
And the market reaction was, well, immediate, wasn't
Oh,
it?
absolutely. We saw Brent crude futures. They surged, hit 5-month highs, pushed past, what, $81 every cents a barrel?
Mm.
While, global stocks, S&P 500, Dow, NASDAQ, Asian markets, they all just tumbled.
Yeah.
So our mission today really is to help you understand why. Why do these events trigger such strong market reactions, and what are the sort of bigger implications?
Well, what's fascinating, I think, is how fast markets price in the threat of disruption. Not even actual disruption, just the threat.
Okay.
The main driver for that oil spike is what analysts call the fear premium.
The fear premium.
Yeah, it's basically that extra cost built into prices just from the possibility something bad might happen. And here, it's tied directly to potential supply disruptions, specifically around the Strait of Hormuz.
Hormuz, always critical.
Always. And here's the thing, it gets really interesting. This channel is incredibly narrow, only 33 kilometers wide at its tightest point.
Wow, that narrow.
Yeah. And yet, something like 20 to 30% of globally traded oil goes through there every single day, plus about 20% of global LNG supplies.
And there's no real alternative sea route, right?
None. Critically, no alternative. Now, even though a full blockade seems unlikely, I mean, it would hurt Iran's own economy badly, plus there'd be a certain U.S. military response.
Right.
And historically, it's never actually been fully blocked, not even during the Iran-Iraq War in the 80s.
Okay.
But the threat alone, just the possibility, that's enough to send prices soaring and, importantly, keep them high. We actually saw prediction markets lower the odds of disruption from 60% down to 48%.
So the perceived risk actually went down.
It did, slightly, but prices stayed elevated.
Huh. That's kind of counterintuitive. It's like the market just holds on to that initial panic.
Exactly. It bakes in that fear, and it doesn't let go easily.
So if oil prices are shooting up like that, what's the direct sort of ripple effect on the broader stock market? Is it just higher costs hitting everyone?
Pretty much. Higher oil means higher costs for, well, almost everyone. Businesses, consumers, think transportation, manufacturing, the cost of goods.
Right.
And that feeds inflation worries. It tends to slow economic growth. And ultimately, it hits corporate profits. Talk about the inflationary drag on consumers.
Okay, inflationary drag.
Yeah, basically, higher prices reduce your spending power. Higher gas prices mean less money for other things. That hits sectors like airlines, manufacturing hard, and also consumer discretionary stuff, retail, cars, things like that.
So a lot of sectors feel the pinch. But is it bad news everywhere? Are there any sectors that might actually, benefit?
That's a good point. It's not uniformly negative. Energy sector companies, for obvious reasons, can benefit from higher oil prices.
Makes sense.
And defense contractors, too. Increased geopolitical tension often boosts spending in that area.
Okay. And, listening to this, it sounds like a new crisis, but these kinds of market jitters, they often have really deep historical roots, don't they? How much is history playing into this reaction?
Oh, hugely.
Yeah.
You're absolutely right. This isn't happening in a vacuum. The market sensitivity, it reflects decades of mistrust, really. You have to remember the 1953 coup.
Right, the US-UK backed one.
Yeah. Then the 79 hostage crisis, the U.S. backing Iraq in the 80s war, the withdrawal from the nuclear deal in, 2015?
The JCPOA, yeah.
And then the Soleimani assassination in 2020. It all adds up.
Yeah.
This legacy of distrust means the market isn't just reacting to this specific strike. It's reacting to decades of built-up risk. That fear premium we talked about. It's deeply embedded.
Wow. So connecting this to the bigger economic picture then, rising oil prices, you mentioned it creates a kind of catch-22 for central banks like the Fed. What exactly does that mean for their decisions right now?
Well, the catch-22 is they're stuck, essentially.
Yeah.
If they focus on fighting inflation, which high oil prices fuel they might need to raise rates or keep them high, which could slow down an already fragile economy.
Okay.
But if they try to stimulate growth, maybe by cutting rates, they risk letting inflation get even worse. There's a genuine risk of stagflation, rising prices and slow growth, especially if oil were to hit, say, $100 a barrel or more.
A tough spot. And what about global trade? Are we seeing impacts there?
Definitely. We're already seeing flights and cargo ships rerouting away from the Middle East airspace and waters. That means longer travel times, higher fuel consumption, higher costs all around.
And I guess that hits some countries harder than others.
For sure. Countries that rely heavily on oil imports are particularly vulnerable. Think India imports something like 90% of its oil, and maybe 40% of that comes through Hormuz. Or Indonesia. They feel these shocks intensely. Currency can weaken, inflation spikes. It's tough.
So bring it back to the listener. What does this all mean for you, practically speaking?
Well, look, markets often do bounce back from geopolitical shocks. History suggests declines might reverse in maybe 2 or 3 weeks sometimes.
Sometimes.
Sometimes. But this event is definitely amplifying existing trends and debates about inflation and growth. For businesses, the takeaway is probably about prioritizing proactive resilience, maybe over pure efficiency for a while, diversifying supply chains, keeping a closer eye on geopolitical developments. For investors, the usual advice often holds. Try not to overreact to headlines, stay diversified, maybe consider some tactical exposure to energy or defense, and perhaps be a bit cautious on consumer discretionary stocks.
Right. It really highlights how interconnected everything is: geopolitics, energy prices, your own financial situation. Which I guess leaves us with a bigger question to chew on. How might this ongoing tension really reshape things long term? Global supply chains, consumer habits. Could we be heading towards, I don't know, a less globalized, maybe more localized economic future because of persistent risks like these?
That's the million-dollar question, isn't it?
Yeah.
Definitely something to keep watching.